so I'm really excited for today's lesson. It actually blows my mind that it has been 4 weeks. It's only been 4 weeks, and we went from, teaching the basics about trading stocks, and now we are talking about, finding the best options. And I actually, shared the master file in my first lesson, and I had this kind of options analysis tool. And, I've obviously created it for myself. I'm really excited for today's lesson. It actually blows my mind that it has been. Okay, perfect. All right, anyways. So I created that tool for myself, and I didn't realize that it would be only just 4 short weeks later that I would be teaching it to you guys. So I'm really excited. It's an amazing tool, and we're going to talk about how to use it to find kind of the best options, stock options to trade. Now, when I talk about how to find the best stock options to trade, I'm talking specifically like in the option train of the stock that you already decided you wanted to buy or sell. So what do I mean by that? I mean that this is not going to be talking about like searching for all the stocks and all the options that exist in the world. I think I talk a lot about finding good opportunities to buy or sell a certain specific stock in my prior lessons 1 through 5, or as well as in my $1 million trading goal challenge videos. So if you're not sure how to find a good stock to buy or sell, go watch those videos. This is going to be like after you find a stock to buy or sell. We're going to talk about how to find the best option in terms of time and price and all that to buy and trade. Okay, so let's go quickly through the table of contents here. So we're going to start off with psychology and philosophy. You guys know I'm a big believer that psychology and philosophy is the foundation for a good trader. You can have all the technical knowledge that you want, but if you don't have a good philosophy and psychology of a good trader, you're going to not do well. Now, and then we're going to talk about margin or cash brokerage accounts. I realized I don't think I answered this question, which should really be in the first lesson. Unfortunately, it's in lesson 6. But I got a few texts from a few friends of mine that have been starting to watch my videos, and they're like, hey, do I open a margin or cash account? So I want to touch on this real quickly. And then we'll go in through the options P&L, which means profit and loss charts walkthrough. In my last lesson, in lesson 5, I felt that I wanted to, I tried to take a shortcut by using Tasty Trade's beautiful charts, but what I realized is I almost did you guys basically a disservice because they were not, like, I realized I made a mistake like halfway through, a question or a example, because the profit and loss chart was not drawn correctly. So I'm going to teach you guys how to draw a profit and loss chart for, a long put, a long call, a short put, a short call, really quickly here. And then we're going to find the best, then we're going to finally talk about the meat of this lesson, which is the best stock options to trade by using the option tab on the master file. And then remember, the master file can always be downloaded in the link in the description below, completely free. And more on implied and volatility. So implied volatility is an extremely important concept. It's actually a pretty complex subject. So we'll see how long we spend on that today. If we don't have enough time, then I may just move it to next lesson or something. And then when to buy stocks versus buying options. And because sometimes there may not be a good option to buy, and so you will want to buy a stock instead if you want to go that direction, or you can sell options, right? And that's always an option as well. And then we're going to have a quick reminder on risk management for options trading, just because trading options is extremely risky, and I want to make sure that you guys are able to do it as safely as possible. And then we're going to go through, not the next lesson. The next lesson is going to be multi-leg option strategies, but lesson 8 probably will be adjusting your options trading positions and managing your risk. Kind of like what I did for Grubhub, my Grubhub options when they lost a bunch of value. Instead of freaking out and selling, I went to look for a better deal, and I got 1 more week of time for my option when I did that. And then number 8 is, can you beat Wall Street traders or make money in the stock market? I think there's you guys probably already obviously believe yes. The answer is yes. But like my dad, he still has a lot of like contention in terms of like, what can you actually make money in the stock market? Isn't it just basically gambling? And I'm going to talk a little bit about how you can and why you can. And then we'll go through the post-lesson actions. So first slide here, these are the same philosophy lessons as the $1 million trading goal challenge video that I just made. I forgot what episode that was, but these are so important that I want to go through them again. Right, number 1, and this is actually kind of new, is remember to think of yourself as a minimum viable product. This is in lesson 1. But now that we're getting to options trading, and this can be like, oh my God, this is so overwhelming, I want you guys to remember that think of yourself as a minimum viable product, like in a tech startup, right? You don't have to know everything. Learn things piece by piece, and this is why when you're still learning, manage your risk and make sure you're paper trading, or if you are trading with real money, trade with as little real money as possible so that you lose as little money as possible when you're still learning how to do this. Do not fall for the analysis paralysis trap, right? A lot of people are like, oh, there's so much to learn. There's so much to learn no matter what you do, right? Even becoming a DJ, it's like infinite buttons, infinite things to learn. But if you take things like the piece by piece and just learn it slowly, there's people always overestimate the amount of things they can learn in the short term and underestimate the amount of things they can learn in the long term. You have your whole life to learn this, right? There's no rush. The stock market isn't going to collapse, although some people thought it might have this year just because of what the hell happened with the coronavirus. But it's not going to go anywhere. So take your time. The stock market will always be there. You'll always have opportunities to trade. So just take it piece by piece and don't fall for analysis paralysis trap before deciding to start to trade. Just start trading with fake money or paper money so that you can make all the mistakes you want without losing anything. Be an open-minded, constant consumer of news. Like I said, you don't need to know everything about a stock before you trade it, but once you are in a position, then go read as much as possible. Go analyze that stock as much as possible, fundamentally, technically, news-wise, all those things, because then you actually have money invested, and then you want to make sure that your money is invested in a good place, right? Read as much as possible, and also from as many different opinions as possible. Don't be closed-minded, right? You want to know what other people are thinking. Don't just confirmation bias yourself, which is only looking for news that supports your hypothesis or your investment thesis. Go read for as many different things as possible so you make sure that you're actually thinking of correctly, and you can also learn things that you weren't thinking of originally. This is what I've learned to really enjoy doing. I haven't really been a big reader my whole life, but after I started making money from the things I read, I started to love reading. So I think that will happen for you guys too. This leads to intuitive investing / educated guess. Talked about that, but basically it's like you have an opinion and you think the stock market reacted appropriately. If you think they overreacted, then you can take advantage of that and make money off of that. The stock market is advice for transferring money from inpatient to the patient by Warren Buffett. Said by Warren Buffett. So this, I want to touch on this even more so. I just glanced over it in the last episode in the other series, but don't force trades or overtrade. That's what it means by being patient. Be patient and wait until you find a good opportunity to trade. There are literally thousands of stocks and thousands of options for each stock. So basically like millions of options and thousands of stocks to trade. And so don't force your trades. Hey, Cyrus, Cryus, sorry, how you doing? Don't force trades and be patient. There are plenty of great opportunities in the stock market to trade. Learn from every trade, both the good and bad. This is really good for a growth mentality. Understand why each trade did or didn't work, and don't just assume it was because your investment thesis was right or wrong. There can be many reasons why your trade didn't work. The stock market is a crazy place, and especially with what's happening in the coronavirus right now. Another thing, like for example, things you didn't think of in your original thesis could have been the reason your trade didn't work, like the Porter's 5 forces. So really do your research and understand why it did. Even if it did work, you should find out if you were right or something else drove you to be right. Like my trades from my last episode that I talked about, I was sort of right, but also the SPY came down a ton. And so that helped my position a lot. And if you don't know what I'm talking about, go watch the episode 5, I think, of the $1 million trading goal that I talked about in my positions recently. Another thing my mom said is learn from the good and learn to not do the bad. I had a really good best friend growing up, and he had a reputation of being a bad kid. And my mom said, you can be friends with him, but learn the good and learn not to do the bad. And I trust you to be friends with him. So that is a big part of making me who I am today, and I think that applies to trading as well. Okay, so margin or cash brokerage account. So create a margin account, but don't use any margin to invest. So in my last lesson 5, I talk about what margin is. So go watch that if you don't understand. But why do you create a margin account instead of a cash account? There are cash accounting trading rules. If you have a cash account, guess what? PDT rules don't apply to you. Oh, that's awesome. Not really. In a way, you actually can trade less because trades placed in a cash account require 2 business days for funds to fully settle before they can be used to buy or sell again. Trade date and then 2 business days after. So you're basically forced to follow like the PD2 rule because you can only trade like once every 3 days. Versus a margin account, they allow you to trade because they know that your stock that you bought or sold is coming eventually. Then they just let you to continue to trade even though it hasn't come to your account or been sold out of your account yet. Remember, everything said on my video is just my opinion based on my experience. Trading is for educational purposes only. Trading is very risky. Nothing I say is advice or recommendation. Read the description to your own risk. So I'm going to start reading that really fast. The disclaimer, it's literally on the screen. It's also in the description. So, just trade at your own risk. And I don't want to waste time to keep saying that every time. All right, the options profit and loss chart walkthrough. So note the stock price always goes from left to right and from low to high. All righty. So because I glanced over this last time, I want to make sure I do it justice this time. Let's use blue. So on the y-axis and then the x-axis. So what's on the y-axis and what is on the x-axis? So here it is. So mark the profit or loss on the y-axis. Y-axis is why you trade. Why you trade. So profit, which is actually this pi sign, it means profit, is the y-axis. And then what is the x-axis? X-axis marks the strike price on the x-axis. So x, or the stock price. X-axis equals x marks the spot, right? The strike price or the stock price. And so this is the price. Doink. Okay, awesome. So I need to erase this now. Cool. So okay. So let's talk about a real option example. Let's just use a SPY here. Random one, doesn't really matter. So okay. So let's just do like 10. This is too much. Okay, so let's look at a call option, and let's pretend you're buying a call option. The current price is 286.28. And then let's buy a 285 call. And the mark price is the price between the bid and ask price that this option is currently trading at. So bid is what people are trying to buy it at. Ask is what people are trying to sell it at. So 2.21. So $221 or 2.21 per share because you always buy 100 shares. And so let's say we're buying a call option. So let's start and go through this in order. Determine the amount of money you are collecting or paying. Since we're buying a call option, we are paying $221, but you always do it in per share basis because the stock price is per share and the profit is per share. So 221, is that right? 220. Oh shoot. Okay. 2.21 per share, and we're paying it, so that's negative profits. Okay. Now you just write a little line here. You marked it on your y-axis. Mark the profit on the mark that profit or loss on the y-axis. Since we're buying it, that's a loss at the start. Mark the strike price on the x-axis. So 285, and then really you can just put a little 0 here because this is 0 stock price and 0 profit. And so 285 is the strike price. Mark the strike price. And then mark the break even on the price of the stock, the x-axis. So when you're buying a call option, the break even is always 285 plus 2.21, right? Because you're trying to go upwards. And when you buy a put, the break even is going downwards. So 2.21 minus 285, but obviously we're doing a call option. So 287.21, and the current stock price is at 286.3. Which I'm just gonna put a circle here. I'm not gonna even show the price, but just know it's there because it's irrelevant what the current stock price is for the profit and loss chart, just so you know. So it's irrelevant, but just so you guys have an idea of how this works. So when then you mark the strike price on the x-axis, done. Then mark the break-even price, which we did here, 287.21. Then draw a line from the profit or loss starting at the strike price. So right here between the profit or loss is 2.21 at the strike price. So here's a little dot here. And then you draw a line at the strike price to the break-even. Since break-even equals 0 profit, so it's touching the x-axis, right? And let me use a different color here. So here is the break-even, 0 profit, break-even price. Negative 221 because we paid that at the beginning, and up until your strike price you make no money, right? If the call option is below the strike price, then your option expires worthless. Then you just draw a little baby line here, yay. Okay, and then you draw. The max you can lose when you buy options is the initial loss, so 221. So this is just a straight line to 221, and then a little break even here. Then from there on, after your break even, you make $1 every dollar it's above the break even price. And so you just draw a line here, and then if this is 283.21, right, then you make $1, right? Just so you know. But this is a dotted line just to show that it's a $1 profit. But the line, and it keeps going into infinity, right? Because the stock price can technically go to infinity, and you can make infinite profit. So this is a call option. Now let's do a selling a call option. So let's do it again. Y-axis is why you trade, profit. X-axis is the strike price. Now let's do, I sold this option to somebody. So I actually collect $2.21, right? And the smart price, the strike price that I bought is $2.85. The break even is still the same. The break even is always the same for the buyer and the seller. Otherwise, it wouldn't make any sense. So 287.21. But since I bought it, your initial point is going to be profit. You're going to be making money. But when you sell an option, a call option or a put option, the most you can make is the initial amount of money that you collected. You're like, wow, that kind of sucks. Well, the chance of success for your option is extremely high. So that's actually why you only can collect a little bit of money, but your probability of success is really high. So trading is all about risk versus reward, right? And then you draw a line from the this little point here to the break-even price, which is zero profit right here. And then you lose infinite money for every dollar it passes. So if this is 288.21, this would be -1 profit, and then so on and so forth. Hopefully you get it now. So we'll do a quick example for a put option. So let's just do a 286. All right, let's do a 287 one. 287, and the mark price is 287 and 3.22. 287 and 3.22. Okay, cool. So let's just buy a put first. 3.22. 3.22. Okay, and then 287. 287, 3.22. So like I said, if it's a put option, you want to subtract. So minus 3.22, and your break even is at 283.78. So you draw the y-axis again, profit, mark, x-axis is the price. And then you bought a put option, so you lost the 3.22 at the start. Let's close this real quick. Oh no, let's just keep it here. Just put it on the side. Okay. And then you draw the mark price, the strike price, which is 287. Oh shoot. Yeah, let's give us a little bit more room here. 287 over here, because we're going to go this way. It's always from low to high. What is your break-even point? It's 283.78. Then you draw a little point at from your loss and your strike price right here, and then you draw a little point here, and then the max you can lose is the initial bought, and then the max you can win is infinite. And so, well, not infinite, because the stock price can only go to 0, but so at 282.78 you would make $1, right? Hopefully that makes sense, because after your break-even point you make $1 for every dollar it passes that. So like $100 really, right? Because you have to times it by 100. Now let's do selling a put option real quick. Boom, boom. You collect 3.22. The strike price is 287. The break even is 283.78. You put a little dot here. The max you can make is the initial collection credit, which we'll talk about in the next lesson, credit and debits, but the amount of money you collected at the start. Then you put a little dot at the break even, because break even means 0 profit. You connect that. Then after that, infinite money you can lose. So if it's $1 below 282.78, you would lose $1. Hopefully that makes sense. how did you get 283? Oh, yeah. So because you paid a certain amount or collected a certain amount, then that's your break even, right? So your strike price is like 287. And then let's do a call side, because call side is a little easier to understand. Well, you actually asked for the 283, so let's just do 283. So this is the strike price right here, 287, and you're paying $3.22 per share times 100, so really $322, but we're doing it by a per share basis on the profit and loss chart always. And so when you do that, you have a 287 put, and so you're trying to make money with the stock price going down. So starting at 287, you start to make money because that's your strike price. That's the promise you bought from the put seller. And so, but you pay $3.22 at the beginning to buy this promise. And so in order to break even, you have to take your 287, which is your strike price, and subtract how much you paid for it at the beginning. The call was 283. Oh, perfect. We can do that too. So the 285, and then you add, the call was 287.21. So the call, if you buy a call option, it's 285 call. You paid $2.21 per share at the beginning for it. So in order to break even, it needs to go past upwards how much you paid originally. So starting at 285, you start making money from your call option. But in order to break even, you have to make at least the amount of money you paid at the beginning for it, which is $2.21 per share. And so if you do 285 plus $2.21, you get 287.21. Okay, hopefully that answered your question, and I will be moving on. Remember, your beginner is normal to not be good at trading or consistently profit yet. That's why you should paper trade, especially when trading options. Got it. Never mind. No, no worries at all. Don't worry about it. That's why I do live streams. I think being able to answer people's question, live is very helpful. And I really enjoy doing it. So thank you so much for watching. Seriously. Okay, so hopefully that was helpful, and you guys understood both buying and selling calls and puts now. So how do you find the best stock options to trade? And so understanding this concept is extremely important, right? Oh, thank you. Yeah, you're welcome. So understanding that concept is extremely important because now we're going to talk about buying options. My tool is purely for the buy side, but in a way it can be indirectly used for the sell side, but we aren't going to be talking about that until a future lesson. And so let's go through the options tab on the master file. Hopefully you guys have all downloaded it from the link in the description below. And let's do that right now. So let's open the master file here and go to the options tab, and this is it. So let's use a real example, right? And I think VTIQ I think we can use VTIQ. So this is VTIQ. I have it already put into this option analysis tab, but just in case you guys didn't see it on my last lesson, VTIQ obviously had a crazy journey recently of going up and shooting down because of the Nikola merger news that came out. Then they're going to decide on in June whether or not they actually go through with the merger. And so I took a look at their options prices as an example, and so let me pull that up here on Thinkorswim. So let's go to VTIQ here and go to their July options, which is what I looked at. Let's expand this a little bit. Okay, that's all of them. Well, all right, so I did $10, and what are these? July, these are calls, right? Calls. Yeah. Okay, yeah, so these are calls. So now, when originally I bought a put because it was way too high, and now it's come down to $22, and I still am pretty confident that the merger is going to go through, and so now I want to look at calls, because now I think that after all this bad news, maybe the stock price will go up in the future. I'm not saying that I'm actually going to trade this. I'm just using this as an example for this lesson, so keep that in mind. Honestly, I don't think I like VTIQ, but I think this is just a good example to use because of how crazy it's moved. So it's easy to understand because it's big movements. But let's see, VTIQ, trade, and July contracts, and I'm buying a call. So this is kind of weird because it goes from lowest to highest. So just keep that in mind, 2.5. These are the strike prices. And these are the mark prices, right? And these are the prices I use. So $10, 12.5 mark. And so you'll see $10, 12.5 cost of option, which is the I'll just put mark here because I'm using mark for this example. Sometimes I use ask. Depends on whatever you want to do. Ask is easier because you can get filled easier when you're buying at the ask price, just so you know. 12.5, 9.55, and you'll see 12.5, 10.3. It's moved a little bit, whatever, it doesn't matter. But it's close enough, right? And so now we're going to do an analysis. So if you understand the break-even point on profit and loss charts, then we can start to be like, okay, well, how much do I need to make? How much does the price need to move to make 100%? How much does the price need to move to make 200%, 300%? And it's pretty simple. In order to make 100%, in order to find the break even, you just add the initial mark, right, from the strike price. So if the strike price is 10 and you paid $12.50, well, then the break even price is $22.50, right? How do you find 100%? Easy, just double it. So if you pay $12.50, multiply that by 2, which is 25, then you add it to the 10. And so in order to make 100% on your investment, you have to reach $35. In order to make 200% in your investment, you need to make 47.5, so on and so forth. I did the math for you, and I created this tool because I'm also lazy. You know, create tools to simplify your life. You don't need to do the math every time if you can just use Excel and do it for you. Or you can use my tool that I've already built for you. So this is a call or a put. If I put this as a put, you'll see that everything switches around, and instead of adding to the strike price, it will subtract from the strike price. Hopefully that makes sense. Okay, and the current price is 22.45. It moved a little, which is why the prices, all the mark prices moved. But as I was preparing this, the current price was 22.45. And so this percentage is the price from current move that it has to move in order to make 100%. And the price from current move, percentage-wise, 3 minus 1. Oh, from the... Oops. Hopefully... I need to update this then. Darn it. I'll update the file in the on the link because this is wrong. This needs to connect to the current strike price. Percentage move from the current strike price to make 100%. Our questions later. Are we using the Excel sheet to follow you? You can, or you can just follow me on screen. But you can download this Excel sheet in the description below. It's called the master file, as you can see up here, master file. And so I want to do the analysis to say, like, let's pretend that we think let's just say like $30 I think is a fair price after the merger. What's up, Randy? Welcome back. That's a good price, and I think it will go up to $30 in the future after the merger happens, right? And that's happening in June. I buy a contract in July to be a little bit safer. So even if I'm wrong, because the contract has time, remember, option prices are made of intrinsic value, implied volatility, and days to expiration. By buying more time, even if I'm wrong on the day that it should happen, I still have about a month of time, so the option will not expire worthless, and I won't lose all of my money in my option that I bought. And that is a risk management strategy when you do trade options that you should be using. So always buy more time if you can afford to, without destroying your break-even price and the option prices, and makes the deal not a good deal. Why did I buy like 1 week or 1 or 2 weeks for my AMC and Grubhub trades that I talked about in episode 5? Is because if I bought too much time, the break-even point and the point, not even the break-even point. You're not trying to buy options to not break even, right? That would be ridiculous. You're trying to buy options to make at least 100% of your money, if not 500%. And you'll see I bold 500% here. But at least 100%, right, on your money. And you know, you'll never lose 100% of your option price if you try to manage your risk correctly. So the risk to return comes out to be about like 3-to-1 or 2-to-1 if you do it correctly. And so we want to focus a lot on the 100% or even the 500% if we can, depending on how good the deal is of the option is. And so let's say we think that the price of this stock will eventually go back to 30. Now we can take a look at all the strike prices. I start from 10 and I go up to 50 because 50 is the highest. And then go look at the prices that I can make 100% profit based on the option strike price and the amount of money I have to pay for the option. And look, I have a little note over here. What you want is when you're buying a put, you want the price to be as high as possible for you to make money. And when you buy a call, you want the price to be as low as possible for you to make money. So min for call, max for put. And oops, I really do need to update this in my tab. This is the max and this is the min. Okay, left is max, right is min. And we'll talk about this later in a future lesson. But so we're looking for the minimum price here, and and so instead of like reading through it, I have this little 2 columns here to do it really quickly. And I see that there is one contract that can make me 100% profit at about $30, and that is at the 17.5 strike price, and I would pay this is the cost of the option, which is $6.55 for, so $655 contract and 17.5 strike at about $30.5. I would make. Now this has a lot of white shirts. I really do. That whole white box over there is just white shirts. Anyways, it's 100% profit is at 30.6 at this one. So I might decide, hey, this looks like a great deal. If the stock price goes to $30 in June, then I'll make 100% profit. And if it goes to $37, I'll make 200% profit, right? And so that's kind of the idea here, and that's how you find the best options to buy. And you can really, like, sometimes I even be a little greedy and say like, oh, what if it go? What's the best for getting 500%, right? Because the best option to buy to get 100% is the 17.5 contract, it doesn't necessarily mean it's the best contract to get 500%. And so you look at the minimum column here. What is the lowest price for the call option? 49.5. You go through this and look for 49.5. And you find that the actual, to make 500% is the 49.5 price, the $30 strike, and you have to pay 30.25 in order to buy the contract, which is $325. But what's the problem here? I want to make 500%, but the strike price for the best one of that is $30, and I only think the price will only go to $30. So no, this is a terrible option, right? In this current specific hypothesis, because I don't think it's going to go. I think it'll be about $30 by July. Let's say this is all fake, right? And so that means this option would expire worthless. You don't want that, right? So essentially, and unfortunately for this specific stock and for my specific investment thesis, where I think the stock price will go up to $30 by June, right? My June is my actual date of when I want to exit the trade, and July is the actual expiration date I'm buying, so that I have more time to manage my risk on my option trade. Hopefully that all makes sense. And so unfortunately, that's not a great scenario. But let's use another example here. Let's just say, what's going on here? Nope. Okay. Let's just say, let's do Grubhub, huh? Let's do Grubhub. And let's say that I want to go buy, trade. And then this is Grubhub. That's weird. Oh, no, it's not. Grubhub. And then I'm going to buy this Friday's call right here. And you always want to start your strike prices, and what's the current price, which is right here, last 54.79 or 97, sorry. And then you want to be a little bit in the money, and what I usually do is like 3 to 4 contracts in the money, just to being in the money when you buy the contract is obviously safer, right? Because you already have intrinsic value. Your contract, even if they expired today, would be worth something, right? And so, and also, intrinsic value offsets extrinsic value, right? Because option price equals intrinsic value plus extrinsic value. So if you look at this call option, I have to pay $6 for a $50 call option. So what is the intrinsic value? Well, 50 minus 55, which is the current price, is the intrinsic value. That means the intrinsic value of this contract is $5. So the extrinsic value, which is like the volatility aspect, is only $1. That's actually a great deal, in my opinion. And so if I was trying to be safe, I would buy this. But why is this? Why do you not just always buy in the money options then? Well, because they're expensive, right? This is 2 times the amount for the $55 contract and like 6 times the amount for the $60 contract, $60 call strike. But why is that? Because it's safer. The $60 call strike option is inherently risky because it has to go past $60 for you to make money. In fact, you have to go past $60 plus the amount you pay for it, which is 1.2, so 61.2 for you to make money. And so the reason why it's 1/6 the price of the $50 contract is because it's way riskier. And you can see delta here. I have delta, and you can change these whatever you want it to be. And you can change this to mark right here, and then delta is the Greeks, right? So delta is two things. One is how much will this option price move for $1 move in strike price, but also it means the probability of success for this option. So the 0.77, and this is always a percentage, is this option has a 77% chance of making money, versus the $60 contract has only a 28%. Now, these are estimates by the market, right? The market is never right. Nobody can predict the future. So just keep that in mind. But this is the market's currently estimate on the probability of success for this trade. To be at the money, I'm pretty sure. So this has 77% chance to be at $50, which means this would expire worthless. Just keep that in mind, because if the option expires, it's at the money, the option is still worthless. So just keep that in mind. That's how these things work. So let's do this as an example. So let's move this here. Perfect. So strike price and there you go. Strike price. No. Okay. Strike price and mark price. So 50. So the current price is 55. The strike price I want to start at is 50. And that would cost 6.05, and just keep going to the right. So this is the change in the strike price. So what is this change? $1. So $1 here, and you have to change each one of these. That's how this tool works. And then 5.35 is the mark price here. And then next one, 52. And I'm just gonna do this, and you guys can follow along, hopefully. 4.85. 52. Oh, I did 52. 52.5. I don't love the half ones, because if you look at the open interest, which is also a really important part, I talked about that in the last lesson. The half 50-cent contracts generally don't have a lot of volume. Actually, this one randomly does. Fine. It does have a lot of volume. How does this one? Not really. This one it does. Okay. I'm just going to not include it, because you really could just buy the contract if you find that in between 52 and 53 is a good price. So you don't actually have to do the analysis on that exact strike price. You can indirectly do it by understanding if the strike prices around that price are a good deal. So I'm not going to do it. I'm just going to go straight to 53 and jump past that one. So 53 is at, oh, shoot, I need to change this back to mark. 53, 4.15. 54, 3.7, 54, 3.7. And if you want to, if this is buying put options, this would be like -1, right? Because you're going down slowly. But I'm going up slowly because this is an call option. And so 55 is at 2.975. So 2.975, which is, let's just be accurate. And then 56. And this is what I do when I find a stock I want to trade, and then I just go analyze whether or not it's a good deal. So 56, 2.825, and then 57, 57, and I'm just going to stop at 57. We don't have to do all of them. 2.125. And if I get lazy and I just don't want to do the rest, what I do is I just make these the same as, make these 0 here, and then make this. And then you can just ignore basically all these, right? Because they're going to be the same. So what I do is, this is a heat grid. So red means low and green means high. And so if you want to be be able to read this fast, you can just use this heat map as well, instead of looking at the min and max. Do you have a cheat sheet we can use to purchase the options? Example, do you have a cheat sheet for this option? What do you mean by a cheat sheet? I'm not sure I follow. I'm doing an analysis to determine which option contract is the best deal to buy. So I'm going to keep explaining. Maybe you can explain what you mean by cheat sheet, and then I can answer your question. So, well, let's say, okay, so it's currently priced at 55 or $50, and I think that this stock can go up to $68. Why? Because let's just say somehow Uber changes their mind and they actually want to pay 2.15 shares per Grubhub share, which is a $68 valuation. And so instead of just looking, I can now look at, okay, $68, where can I get the best deal? So I can actually get right here. So this would be the best deal. I can get 400% return on my money at a $68 valuation here versus a $68 here would only be 300%. $68 here would only be 300%. $68 here would be 300%. $68 here would be less than 300%, right? Because this is 69. About 200%, 200%, 200%, 200%. So this is the best deal right here. And so then I would go and buy the $57 contract for $2.13 per share, which is $213. And boom, $57 is the best deal out of all the call options. But since this is the max and this is the best deal, well then I should just keep going and seeing if there's actually better deals on the other contracts. But we're not going to do that. Hopefully that concept makes sense. If it doesn't, come back to this video, maybe watch it a few times. If you still are confused, leave a comment below and I can try to answer your question. Alrighty, so let's move on here because there's still a lot of stuff I want to talk about. No, don't log out. Okay. So, but there's almost no such thing as a bad deal in options. Why? Because I just talked about like a good deal for buying an option. Well, then guess what? If it's not a good deal to buy it, then maybe we can sell it, right? And so that's always an interesting thing about trading options is that you can always buy or sell the option. You don't have to buy the option. And that's why I love trading options instead of trading stocks, because there's a lot more flexibility in terms of what you can do when you are trading options. Instead of buying a call option, maybe I can buy a put option. There's just so much flexibility. Then you can always just sell and short the option. Okay. Snaking the chain. So start at a low limit price and then slowly move your way up the limit price until you find your order is filled. Because options are a little bit less liquid than stocks, right? Because stocks are like, they're moving around constantly. They have a ton of volume, 9 million versus like, let's say the freaking open interest here. What is it, like a few hundred, right? There's only a few hundred contracts that are sold total so far. And so what you can do is, this is the lowest price people are willing to pay to buy it, and this is the price that the lowest price people are willing to sell it for. And so you can start at the lowest price and slowly move your way up to the 3.2 so that you don't have to pay full price for it. That's called snaking the chain. Start at a low limit price, then slowly move your limit price up until your order is filled. That's called snaking the chain. And that's how you try to find the best deal for buying an option as well. That's part of it. All right, let's talk about volatility because this is a very important concept. So cheat sheet for the option to buy. The steps to look for when you purchasing the option price. Cheat sheet for the option to buy. The steps to look for when purchasing the option price, delta, etc. Do you have a cheat sheet we can use to purchase the options? Example, do you have a cheat sheet for this option? I don't know. I don't have a cheat sheet, unfortunately, but this analysis is basically what a cheat sheet, I think, what you're looking for. You do this analysis so that you can find which stock option you should buy based on your investment thesis or hypothesis on what price you think the option will move to, right? Because, for example, in my first example, VTIQ, we thought the option price would go to 30, and which is why we chose as whatever contract, I think it was 17.5. That was the best deal, so we bought that one. And then in the next option, Grubhub, we thought the price would go to 65. All examples, these aren't real examples. We thought it would go to 68 or 60. So we bought the whatever contract that gave us the best return, like 400% return versus 300 or 200% return. That option, I think it was $57 strike price call option because of the analysis that we did. So that's the cheat sheet. There isn't really a cheat sheet per se, but this tool is to help you find what is the best option to buy based on your investment thesis. Okay. Hopefully that answers your question. If not, maybe continue to ask your question in a few different ways. I'll try to answer it during this live stream. And so let's talk about implied volatility. And so this is a very complex topic. But I'll try to explain it as not little, as simply as possible. So implied volatility is the market's expectation for how much the price will move in the future. And implied volatility, it's always a 1 year estimation. So, and it's implied. Why is it implied? Because it is what the market expects based on what the option prices are saying, right? This is based on, okay, awesome. Thank you so much. So it's based on what the options are saying, and we'll go through a real example in a little bit. And remember that options are traded by real people, which is why volatility changes all the time, because stock option prices are changing all the time, right? It's not done by a computer. These are done by real traders. And so IV is always expressed as an annual percentage or a 1 year percentage. And so let's go through a quick example. 1 year expected range, because that's what IV is. Let's say we do Coca-Cola, right? So let's say Coca-Cola is trading at $50 a share, and the expected the IV is 10%. So you do this formula here. So what is 10% of 50 is hopefully you guys can do that, but I'll just do it for you. It's $5. And so the expected range that the stock price in 1 year is 50 plus or minus 5, right? So $45 to $55 would be Coca-Cola's expected 1 year range based on their implied volatility. And implied volatility is a statistical measure. It represents one standard deviation stock price movement over a 1 year period. In statistics, a one standard deviation range encompasses about 68% of the outcomes around the mean or average. In the context of the stock market, the current price is used as the mean or average. What does this mean? The simplest explanation of this is basically that $45 to $55 range there's a 68% chance that this will be right based on the math. That's what it means. And then if you do a 2 standard deviation move, 2 standard deviations is a 95% range. And so the standard deviation is a fixed measure. So we already calculated that the standard deviation, which is the stock price times the IV, is $5 for Coke if it was a 10% implied volatility with a $50 stock price, right? So let's add 5 more or subtract 5 more. And so from $40 to $60, that means there's a 95% chance that in 1 year, Coke's price will be between $40 to $50. And you can see this math in Thinkorswim. I love Thinkorswim. Now you're starting to understand why. There's just so much that they do for us that we don't have to do for ourselves. And we can do this by looking at the profitability analysis. And let's just go to Coke, for example. And so let's see what is their implied volatility actually. So their implied volatility is currently 34%, right? And their current stock price is 43.26 times 34%, 14.855. And so if you go to the Analyze tab and you go to the analysis, in 1 year, right now it is May 16th, and let's see if they even have going out that far. Unfortunately, they don't. But this is the one standard deviation in each of these time periods. So May 22nd, this Friday, you can see on this line, there's a 68% chance it will be between 41.33 and 55.13. And the more time you have, the higher the volatility, the range, because there's more that can happen in a longer period of time, right? And so by, what day is this? September, the range is from 51.16 to 34.23, and this is a 68% chance. And you can tell right here, it's like you see that 16 and 84, and 84 and 16. So basically, there's 16% chance it will be above 51.16, and there's an 84% chance it will be below 51.16. And over here, it's the opposite. So there's an 84% chance that it will be 83% chance it will be above 34.23, and a 17% chance it will be below 34.23. And if you wanted to do 2 standard deviations, unfortunately the graph is not big enough, but we can do it in a shorter time frame. Just look for 2.5%, right? So, and the price is on the left here. So 2.5%, 2 standard deviations would be right here, right? Because it encompasses 95% chance in 2 standard deviations, and so that means there's 2.5% chance on both sides. So the 2 standard deviation mark for May 28th is $49, and where's the 2.5% chance here? $38, 38 and 49. So in 2 weeks, that is the 2 standard deviation range, and this is the 1 standard deviation range. I'm gonna spend way too much time on this. Unfortunately, it's such a complex subject, but I'm gonna talk about this more next lesson. But that's what mainly I wanted to talk about here. Let's talk about IV run up. We'll talk about this in the next lesson. And you can also calculate this kind of expected range based on the option prices at the money. So let's say, remember this right here. This is a 1 standard deviation range, 46 to 40.14 in 2 weeks. So we go to the trade tab. Let's look at 2 weeks. Is that 29th? Oh, I can't read. Yeah, May 29th. So that's 2 weeks. And you look at the money. So at the money is basically as close as possible, or a little bit in the money. Okay, yes it is. Yeah, it's a very complex subject. So $43 is in the money for a call because it's currently at 43.26. If you see the call option price, it's $1 and $1 and basically $1.2. You go to the analyze tab, go up $1.2. So you'll see that the theoretical implied volatility doesn't reflect the actual option prices, right? And this is because options are traded by real people, and implied volatility is calculated by a computer. And so that is why there's a difference. But you can also say that this is what the traders think it will move, because if I'm an option seller, I must be willing to sell it because I don't think I I hopefully will not lose money if I sell this option at this price. So $1 and $1.17 move from 43. That means my break even would be 43, right? 43 plus 1.17, 44.17. And then the opposite is true for the put. And put option at the money, slightly in the money, is 43.5, which is above 43.26. And the mark is 1.11. So in a way, I mean, if you look at 2 weeks, the prices are pretty cheap, right? If you consider that the theoretical range is 40 to 46, and the at the money option prices are only pricing in from 44 to, what is this? 43. 43.5. Shoot. 43.5 minus 1.1. Darn it. Sorry. 43.5 minus 1.11. $42. So $44 to $42 is currently what the price of the options are. So this could potentially be a trade that you want to enter. I wouldn't buy both calls and put because you can only have one right. And so we'll talk a little bit about this as well when we talk about multi-leg options in next week's lesson. But if you pay $1 here and pay $1 here, but only one of them can be right, you have to consider that you paid a total of like $2, and so your break even is actually your total amount paid if you buy a call and a put, and it pushes your break even farther. And so let's see. Actually, I think that is actually the math here that makes this make sense. Plus 1.11 plus 43 is 45.28. And so this is actually closer to what it is. And essentially it's saying if you bought a call and a put at the money, then you'd probably break even based on the actual theoretical range of 1 standard deviation. Hopefully it's kind of a mouthful, but hopefully that makes sense. And if it doesn't, I'll talk a little bit more about multi-leg options. By buying and selling options, you almost never buy a call and buy a put because only one of them can be in the money. But you could sell a call and sell a put. Why? Because only one of them can make you lose money. And that is a beautiful thing about selling options. And that's a really cool thing we can talk about next week. What was the range again on the other chart? Yes, it is. Okay, yeah. So here's the range here. So this is a 1 standard deviation range, which means that this big bold yellow line there's a 68% chance that it's between these 2 lines. And you can also look at the percentages here. It tells you like the percentage on top means the percentage it's above the 45.19 price or below the 45.19 price. So 14% chance it's above 45.19 and 85% chance it's below 45.1. And it moves the farther you go out, right? It all moves. So this is a dynamic tool that you can look and guess the price. Cool. Awesome. So that's good. How do we tell if it's low or high? We'll talk about that next week. Okay, so let's talk a little bit about this. So when do you want to buy an option, buy a stock or buy an option? So, you may want to consider just buying an option or buying stocks instead. And I think a great example of this is VTIQ. If the options are very badly priced. So let's say I think that the stock price for VTIQ by July, it will only go to $25. Let's just use that as an example. But if I go the strike price at $20, I have to pay $5.55 for that. So that means 20 plus $5.55, I break even. I actually lose 55 cents at 5. Actually, I lose all of it, actually, right? Because it's out of the money. Or it's, no, I only lose 55 cents. Because I think the stock price will be $25 by July. And if I bought the $20 strike, I have to pay $5.55. That means my break even is at $25.55, which is above where I think it will be. So in these instances, it may just be better to just buy the stock. If you think that the move is not going to be big enough, right, and the options are too expensive for you to make money, then you may want to just buy the stock. Another way you could think about it, actually, is you may want to consider selling the options because buying the option is not a good deal. So there's two ways you can play it. You can buy stocks directly instead of buying the option, or you can sell options. And this is why I said if you don't know how to trade options, you're basically handicapped as a trader because you're limiting the options, or funny enough, limiting the tools that you have to make money. Right? Before you can only buy or sell the option, but now you can also buy or sell. You buy or sell the stock. Now you can also buy or sell options. And not only buy or sell options, you have two choices. You can buy or sell a call option or buy or sell a put option. And so you have 6 choices of making money, and actually more than that because you can do multi-leg option strategies, which is a combination of buying and selling options that make really, really interesting results that I'll talk about on next lesson. So that is when you may want to consider buying a stock instead of just buying the option when the option prices are too expensive. You're looking for deals. Okay, so risk management. I just want to quickly show this slide again. Remember, it's very risky to trade options if you don't understand them. It's way riskier than trading stocks. Keep your positions to 2% of your total capital for now. Like I said, you can maybe buy more time so you don't lose your full option price, but it's still risky, right? So you just got to be very confident and you understand options very well. There's an importance of timing your trades as well as possible. That's why you use the strategies like the swing trade strategies to determine if it's a good place to buy the option. If the stock price is low and you think it's going to go up, well, you want to buy the option or the stock. It's the same concept at as low of a price as possible so you have a high chance of it going high and a lot of room for it to go up. And then always buy more time on options so that even if you're wrong and the stock moves if you're wrong in the direction the stock moves, you are still able to recoup a percentage of your original investments because there's still implied volatility and time decay on your option, right? Why did I want to buy one more month on the VTIQ option? I want to buy July instead of June because even though the decision is in June, in case I'm wrong, I still have one more month of priced into the option, so I won't lose 100% of what I invested into that option because I have one more month of time and I'm going to sell it when it still has one more month of time. Remember that options are depreciating assets because they're priced by days to expiration is a component of their price, and so as each day passes, you have less days to expiration and your price of the option will go down. And if possible, try to make your plays free. So what I like to do is actually buy at least 2 options. And so when I hit 100% profits, I can just sell one of them and then break even on that position. And I have one more option it's basically free. And hopefully if it continues to do well, then I can make money on my second option that I didn't sell. And that's a really cool thing you can do with options. You can't really do that with stocks. Why? Because stocks rarely give you 100% returns, right? Options can if you find a good deal. And this is why I like options trading. It's like shopping. Well, I don't like shopping, but I like the concept of shopping and finding good deals. I love finding good deals. It's in my blood and probably my race. And 1 day swing trade. So if you want to swing trade options, use at the money options to day trade, which means that the delta is 50. That means $1 move is a 50-cent move in the option price. So you can do the math very quickly. Pay close attention to theta. That is the amount of price, the decay that your option will lose in value. And so generally, the more time you have, the better. And then estimate the potential gains and losses using 50 delta. The math won't be exact, but it will be close enough. So when you want to do 1 day swing trades, it's actually better to buy less time, unfortunately, but you will be destroyed by theta, so be very careful. Important, do not use this strategy for earnings. Why? Because during earnings, IV is really high, and after earnings, it drops down a bunch. What does that mean for an option price? Coming up to earnings, the price of options won't actually change that much. And you're like, well, what? I thought IV comes up. Yes, IV comes up. And I want to talk about this in my next lesson more. But IV comes up while what happens? Well, you're coming to earnings, you're losing days to expiration. So you would have expected your option price to lose value. But because earnings IV comes up while your days to expiration goes down, they kind of balance each other and option prices don't move a lot. And then once after the earnings comes out, option prices tend to drop a lot because they don't have the IV to support the losing of days to expiration anymore. Hopefully that makes sense. And that is what is called IV crush. So do not trade earnings with options. It's very risky. You may want to consider selling options though during earnings instead. So can you beat Wall Street traders? Can retail traders, which are like us, normal people, make money trading since they must compete with smart money, which is like institutional money, the people on Wall Street? This is the wrong mentality. You're not competing with them anyways, right? You're competing with yourself only. You try to be 1% smarter than yourself every day, and you'll be 38 times better every year. That is the power of compounding interest, and I'll even show it to you right now. Oh, darn it. I don't go out that far, but just trust me, you can do the math yourself, but it's true. If you're 1% smarter every day, relative wise, you'll be 38 times smarter by the end of the year. So that's the power of learning a little bit every day. Can you make money in the stock market? You can definitely make money in the stock market. Why? Because most stock prices in the stock market are overreactions. And you're simply looking for to take advantage of when the stock market makes an overreaction move and ride the trend when it corrects itself, which happens a lot more often than you think. Okay, cool. And then post-lesson actions, like I said in my last lesson, this is a very complex subject. I can try to teach it in 2 hours, but it's for a lot of information. So what I recommend instead is to go and learn more on your own so that when I do go into the complex ideas, you already have a really strong understanding, and I can teach you guys the fun stuff, which is taking advantage of this information instead of just understanding this information. Go through Tasty Trade's free online courses on their website. Go watch Tasty Trade YouTube videos. They're free as well. Start with the options trading concepts and Mike and his whiteboard playlist first. That's an amazing playlist. Go start paper trading and go practice using options trading in your paper trading account. Comment below if you want me to cover anything specific in future lessons or if you have any questions from this lesson. And then lastly, let me know if you have any other questions. That is it for today. Hopefully you guys learned a few things. I'll stay on for a couple minutes and then I'll head off. Any questions? Yeah, it's unfortunate. I couldn't cover everything on implied volatility. I mean, you guys can probably read some of this on your own, but on the slide. But the concepts that I want to talk about here are a little bit complicated. Some of these YouTube videos are like 30 minutes just talking about implied volatility. So, we'll get to this next lesson, hopefully, or if not, it'll be a lesson of its own because multi-leg option strategy is extremely complicated as well. What's the topic for the next stream? The next stream, next Saturday, is multi-leg option strategy. So it's combining long calls and puts with short calls and puts and putting them together to make more complex strategies. And honestly, I think it won't even be multi-leg. It may just be call spreads and debit spreads, depending on how long it takes to teach those concepts, which is the first step. Naked calls and puts are the first step. The second step is calls and debit spreads, which is combining a call, selling a call and buying a call, or selling a put and buying a put. And then the third step is putting those credit spreads and debit spreads together to make even more complex stuff. TIN, traders in pajamas. Nice, thanks. I like that. Can you explain swing trade? Yeah, so a swing trade is pretty straightforward. A day trade is buying or selling something, the same thing, in one day. A swing trade is buying something and selling it in another day. That's just what a swing trade is. The difference between swing trading and long-term investing is swing trading is really more thought of like medium term. So you buy or sell something in like a day or a month or a few months, but usually less than 12 months. That's called a swing trade. And then a long-term trade is usually held for, more than 1 year, usually like 20 years or something. All right, any other questions? Otherwise, I'll be hopping off. As always, thank you guys so much for watching. I really do appreciate the support and you guys coming out to these live streams. As always, may volatility be ever in your favor. I have some really interesting videos coming out next week during the middle of the week before the lessons and my Friday recaps. I will be doing I'm going to go through every trade that I have ever done, starting from like February to April, which is kind of the start of my full-time trading career, and talking about the explanation and giving proof of the results, obviously, why I made each trade. And then I will be, my second video is like talking about why I quit my job, and then, and what I learned and what caused me to quit my job, basically. Awesome. Well, thank you guys. Have a great day as well. And I'll see you guys on my next video. Take care.